The United States has enacted punitive tariffs of 50% on Indian goods in response to India's continued importation of Russian oil, a move that threatens to significantly impact Indian exports. This escalation follows unsuccessful negotiations, with the tariffs aimed at countering perceived threats from Russian affiliations. The increase from the previous 25% to 50% duties could slash Indian exports by over 40%, or nearly $37 billion, affecting key sectors such as textiles, gems, and jewelry. The tariffs, which came into effect under a presidential decree by Donald Trump, have raised concerns about destabilizing foreign investment in India's stock market and potentially damaging U.S.-India business relations. India's response to the tariffs includes seeking alternative trade partnerships with China, Latin America, and the Middle East, as well as pausing plans to purchase U.S.-made weapons. Prime Minister Narendra Modi's reported refusal to engage in dialogue with President Trump signifies the growing diplomatic rift. Despite the strategic importance of U.S.-India relations, India's economic reliance on discounted Russian oil, which constitutes nearly 40% of its imports, complicates a shift away from Moscow. The situation underscores the delicate balance India must maintain between its partnerships with the U.S. and Russia, as the economic implications of reducing Russian oil imports could drive global oil prices to $200 per barrel.
Simulations Plus, Inc., NASDAQ, SLP, is under scrutiny following a significant 25% drop in its stock price after disclosing a substantial asset impairment and abruptly terminating its contract with Grant Thornton, its independent auditor. The company reported a $67.3 million net loss for Q3 2025, largely due to a $77.2 million impairment charge to align its asset book values with the current market valuation. The sudden auditor dismissal raised red flags, as Grant Thornton had previously communicated unresolved concerns regarding the company's segment reporting and internal controls to the SEC, contradicting Simulations Plus public statements. The law firm Hagens Berman has initiated an investigation into whether Simulations Plus misled investors about the reasons for the auditor's dismissal and the accuracy of its financial statements. This situation highlights potential governance issues within Simulations Plus, which could have far-reaching implications for investor trust and the company's market valuation. The investigation seeks to determine if investors were provided with a complete and truthful account of the company's financial health, with potential legal repercussions for Simulations Plus if any misconduct is uncovered.
Centene Corporation, NYSE, CNC, a leading healthcare company, is facing a securities class action lawsuit filed by Hagens Berman, a national plaintiffs' rights law firm. The lawsuit alleges that Centene misled investors by providing an overly optimistic view of its business, particularly its health insurance marketplace enrollment figures. This alleged misinformation came to light after the company withdrew its 2025 financial guidance, citing an independent actuarial review that revealed lower than expected market growth and inconsistent morbidity levels. The revelation caused a dramatic 40% drop in Centene's stock price, erasing billions in market value. The lawsuit, Lundstrom v. Centene Corporation, seeks to represent investors who purchased Centene securities between December 12, 2024 and June 30, 2025. The complaint underscores a significant disconnect between Centene's public optimism and its internal data, leading to substantial financial losses for investors. Following the lawsuit's filing, Centene reported a second-quarter diluted loss per share of -51 cents, attributing it to reduced revenue estimates. This legal action highlights the critical importance of accurate financial disclosures and the potential repercussions of corporate misrepresentation on investor trust and market stability.
The recent listing of two iconic office hubs in Atlanta and Philadelphia highlights the ongoing challenges in the commercial real estate sector, particularly in urban office spaces post-pandemic. The Peachtree Center in Atlanta and Center Square in Philadelphia, both significant landmarks in their respective cities, are now on the market after experiencing years of dwindling occupancy rates. Peachtree Center, a six-tower complex with a rich history, has occupancy rates ranging from 8% to 74% and is expected to sell at a discounted price. Meanwhile, Center Square, Philadelphia's largest office property, is only 36% occupied and is expected to sell for significantly less than the $375 million CMBS loan backing it. These sales underscore the broader trend of declining demand for traditional office spaces in urban centers, driven by the shift to remote work and hybrid models. The low occupancy rates and financial struggles of these properties reflect the uneven recovery of the office market, despite some cities like Atlanta seeing a smaller decline in office visits. The potential conversion of these properties into mixed-use developments could signal a shift in strategy for urban real estate, focusing on creating multifunctional spaces to adapt to changing market demands. This trend could have significant implications for investors and developers as they navigate the evolving landscape of commercial real estate.
The Dallas City Council has approved a $2.7 million incentive package to attract Scotiabank, a prominent Toronto-based financial institution, to establish a regional U.S. center in Dallas. The proposed site, Victory Commons 1, is poised to host over 1,000 jobs with a minimum salary of $135,000, contingent upon Scotiabank's selection of Dallas over competing city Charlotte, North Carolina. This move is part of a broader strategy to position Dallas as a burgeoning financial hub, a sentiment echoed by Councilmember Chad West, who highlighted the city's growing stature in the financial services sector, akin to Wall Street. This development follows the recent establishment of the Texas Stock Exchange and the relocation of the New York Stock Exchange's Chicago office to Dallas, underscoring the city's increasing appeal to major financial players. Should Scotiabank choose Dallas, the local economy could see a significant boost, further cementing the city's reputation as a financial services center. The decision is pending, as Scotiabank has yet to comment on the incentives or their timeline for finalizing the location of their new U.S. lending presence.
Petco Health and Wellness Company, Inc., NASDAQ, WOOF, is facing a securities fraud lawsuit, with Rosen Law Firm urging investors who purchased securities between January 14, 2021 and June 5, 2025, to consider joining the class action. The lawsuit alleges that Petco made false and misleading statements regarding the sustainability of its pandemic-driven growth and the strength of its business model, which primarily focuses on premium pet food. Investors are claimed to have suffered damages when the true state of Petco's business was revealed. The deadline for investors wishing to serve as lead plaintiffs in the case is August 29, 2025. The Rosen Law Firm, known for its success in securities class actions, is spearheading the legal effort, highlighting its history of securing significant settlements for investors. This case underscores the importance of transparency and accurate disclosures by companies to their investors, as misleading information can lead to substantial financial losses and legal repercussions. Investors affected by the alleged misrepresentations have the opportunity to seek compensation, though no class has yet been certified.
On Wednesday, the U.S. stock market remained largely stable as investors awaited NVIDIA Corporation's earnings report, a key indicator for the technology sector and broader market sentiment. While the S&P 500 and NASDAQ 100 each dipped by 0.1%, the Dow Jones Industrial Average increased by 0.2%. NVIDIA, a major player in the AI sector with a market capitalization exceeding $4 trillion and comprising 8% of the S&P 500's weighting, saw its stock price fall by 0.5%. Options traders anticipate significant volatility in NVIDIA's stock, with potential swings of 5.9% post-earnings. Analysts project a 53% year-over-year revenue increase for NVIDIA, driven by strong data center sales for AI workloads, and expect the company to deliver over 50% growth in both the July and October quarters. CFRA has raised NVIDIA's stock price target from $196 to $206, maintaining a buy rating due to confidence in its growth prospects in AI-driven solutions across various sectors, including data centers, autonomous vehicles, robotics, and cloud services. Despite global economic uncertainties, the S&P 500 is poised for an eighth consecutive quarter of profit growth, with corporate earnings projected to rise nearly 11%, surpassing initial forecasts. While NVIDIA's performance is crucial for AI investment trends, CFRA notes that other AI stocks might offer higher potential returns with less risk, particularly those benefiting from geopolitical trends like onshoring and tariff impacts. Investors are closely monitoring NVIDIA's earnings as a bellwether for the broader AI and semiconductor industries.
Impact Finance, an emerging Ethereum-based cryptocurrency project, is nearing the completion of its pre-sale rounds, which have sold out rapidly, indicating strong investor interest. This coincides with Ethereum's impending $2 billion staking unlock, which will release nearly 880,000 ETH from staking contracts. This event is expected to introduce short-term market volatility and could redirect liquidity into early-stage altcoins like Magacoin Finance. Ethereum's price stability around the $4,000 mark, with resistance at $4,200, $4,300, suggests that this unlock will test market resilience and potentially benefit smaller tokens. The success of Magacoin Finance's presale highlights growing confidence in the project, particularly as it seeks to capitalize on market shifts caused by Ethereum's liquidity changes. With a smaller market capitalization than Ethereum, Magacoin Finance can experience significant price movements with relatively modest capital inflows. The project has also gained attention for its cultural relevance and alignment with broader political and financial narratives, enhancing its visibility beyond traditional crypto circles. As the Federal Reserve's upcoming interest rate decisions add to market uncertainty, Magacoin Finance is strategically positioned to benefit from potential liquidity rotations in the cryptocurrency sector. This underscores the importance for investors to balance their portfolios between established networks and emerging projects with high growth potential.
Open Door Technologies Inc., Open, is experiencing a notable downtrend, with its stock price repeatedly encountering resistance at approximately $4.85 since July 2023. This resistance level has become a psychological barrier for investors, driven by buyer's remorse from those who purchased shares at this price point only to see the stock subsequently decline. As these investors seek to exit their positions at break-even, a significant volume of sell orders accumulates at the $4.85 mark, perpetuating the resistance and potentially triggering further sell-offs. This recurring pattern indicates a lack of confidence among investors in Open Door's ability to sustain higher valuations, leading to a potential snowball effect where sellers undercut each other, driving the stock price lower. The situation underscores the importance of technical analysis in understanding market dynamics, particularly the impact of resistance levels on stock performance. If Open Door fails to break through this resistance, it could signal continued volatility and a bearish outlook for the company in the near term.
First General Corp., through its subsidiary Energy Development Corp., EDC, is set to expand its clean energy footprint by tapping into Indonesia's significant geothermal resources. In a strategic joint venture with Point DSSR Daya Mas Sakti, a Siner Mas subsidiary, EDC aims to develop geothermal fields with a combined potential of approximately 440 megawatts (MW) across several Indonesian regions, including West Java and Central Sulawesi. This move aligns with EDC's strategy to leverage its extensive geothermal expertise, honed in the Philippines, to bolster Indonesia's renewable energy sector. The partnership is expected to facilitate knowledge transfer and capacity building, enhancing Indonesia's ability to exploit its geothermal potential, which constitutes about 40% of the world's resources but remains largely untapped. This joint venture underscores a broader trend of international collaboration in the renewable energy sector, driven by the need to address climate change and transition to sustainable energy sources. For Indonesia, which has developed only 10% of its geothermal capacity, this initiative could significantly boost its renewable energy output and contribute to economic and environmental benefits. The collaboration not only positions FirstGen and EDC as pivotal players in the Southeast Asian renewable energy landscape, but also reflects the growing importance of strategic partnerships in achieving global clean energy goals. As such, this development could positively influence investor sentiment towards FirstGen and its partners, potentially impacting their market valuations and future investment prospects in the renewable energy sector.